The average American worker will trade 89,000 hours of their life for money. Not 90,000, 89,000 based on a 43-year working life with 2 weeks of vacation per year. 89,000 hours, priced by the market at roughly $27 per hour across all sectors. That's $2.4 million in gross lifetime wages. Before taxes, which take 30%. Before healthcare premiums. Before mortgage interest, which for the median home buyer amounts to paying for the house twice over the life of the loan. After all that, Federal Reserve data shows the median American household near retirement has about $250,000 in investable assets, $250,000 from $2.4 million in lifetime earnings. That's a 10-cent return on every dollar ever earned. Now, here's the other number. The top 1% of Americans hold approximately $31 trillion in wealth. The majority of that was not accumulated by working. It was accumulated by owning, by holding equity in things that generated returns without the holder's presence. The math gap between those two groups is not explained primarily by intelligence or education. It is explained almost entirely by asset structure, by whether your income works while you sleep or whether it only shows up when you do. Today, I'm going to show you the exact mechanics of that gap, not the politics of it, the physics. And then I'm going to show you how to start fixing your position, specifically with real numbers starting this month. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Here's the frame I want you to hold for this entire video. There are two ways to make money in the modern economy. You can drive the taxi, or you can own the toll road. The taxi driver is skilled, experienced, maybe excellent at what he does, but the moment he parks the car, the income stops. Every dollar he earns requires another trip, another hour, another gallon of fuel from his finite supply of years. The toll road is different. Every time someone else drives on it, you get paid. You don't have to be awake. You don't have to be present. The toll road doesn't care what time it is, whether you slept well or whether you're sitting on a beach in Portugal. It collects always. Most of you were trained specifically, intentionally trained to be taxi drivers. And the first thing I want to do is show you where that training came from. Not to make you angry. I find it more absurd than enraging, but because you cannot rewire a circuit you've never identified. So let me start with a part of the system that should make you reconsider every tax document you've ever skimmed. And then we'll get to the part that should make you reconsider every major career decision you've ever made. Before I get into the psychology that keeps smart people stuck permanently in the taxi, and that section is going to hit harder than you expect, let me show you something in the tax code that the people running the system really hoped you would never read carefully. The United States tax code is approximately 4 million words long. It is objectively one of the most boring documents in human civilization. I've spent time with it. I've sat with fiscal lawyers and tax attorneys who've spent careers inside it. And here is what it says in plain language, if you read it as a set of incentives rather than a set of rules. The government wants you to be an investor. It does not want you to be a worker, and it wrote the rules accordingly. If you earn $1 as an employee, as labor, you pay ordinary income tax. Depending on your bracket and your state, you are paying somewhere between 30 and 42% combined federal, state, and payroll before that dollar reaches your bank account. If you earn $1 as long-term capital gains from an asset held over a year, you pay between 0 and 20%. If your income puts you in the 15% capital gains bracket, which covers a wide range of middle-class investors, you are paying exactly half the tax rate of a salaried employee at the same gross income. Half. Not a rounding error, not a clever loophole, the published rate, chapter and verse, .irs.gov. Go read it. Warren Buffett said his secretary pays a higher tax rate than he does. People got angry. They thought he was bragging. He wasn't bragging. He was reading the tax code out loud. The secretary earns labor income. She pays labor tax rates. Buffett earns capital gains and dividends. He pays the preferred rate for ownership income. The government literally wrote that preference into law because it needs capital deployed productively, and it rewards the people who deploy it. Here's the compounding effect. Over 30 years, if two people both earn $200,000 per year, one as an employee, one as an investor, the employee keeps roughly $600,000 less over that period, purely from the tax differential, not from different investment choices, not from different work ethic, from how the income is categorized. The taxi driver and the toll road owner can earn identical gross income, and the toll road owner retires hundreds of thousands of dollars richer on the same numbers because the government taxes the roads differently. There's a second mechanism running underneath the tax code. It's called inflation asymmetry, and it's the slow motion version of the same dynamic. When the Federal Reserve creates money, or the government runs a deficit, asset prices respond first. Stocks rise. Real estate rises. Business valuations rise. Owners get richer immediately. Consumer prices follow, but with a lag, bread gets expensive 6 months later, gasoline 2 months later. And wages are what economists call sticky. Your employer doesn't wake up the morning a CPI report drops and adjust your salary upward. You get your review once a year, if you're lucky. Meanwhile, you've been eating the inflation hit for 12 months on a salary that hasn't moved. As long as you sell time, you're always on the losing side of the inflation equation. As long as you own assets, inflation is doing your work for you. It reprices your holdings before it touches your grocery bill. So the tax code penalizes labor and subsidizes ownership. Inflation enriches asset holders before it hurts workers. You're in the taxi, wondering why the guy with the toll road seems to keep getting richer without visibly trying harder. It's not magic, it's math. It is written in documents anyone can access. Now, this is where it gets really interesting. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Because here is the reversal I need you to hear clearly. Because this is where most people misdiagnose the problem entirely. You think the issue is that your salary isn't high enough. That is the wrong diagnosis. I've met people making $250,000 a year as employees who are more financially trapped than people making $70,000 a year who own assets. The number on your paycheck is almost irrelevant. What determines your financial freedom is whether that income stops when you stop. And for a salaried employee, it always does. The real problem is not insufficient income. The real problem is structural dependency. And structural dependency has a psychological architecture that is far more powerful than any tax rate. This is the part that kept me up for years because I kept meeting brilliant people who'd read the same books I'd read, who understood the math, who still couldn't pull the trigger on building anything. It wasn't a knowledge problem. It was a programming problem. In a few minutes, I'm going to walk you through exactly how to exit the taxi with a specific framework and real dollar figures. But first, let me show you who designed the cage, because once you see the blueprint, the bars become a lot easier to identify. Let me tell you about Frederick Winslow Taylor, because he is arguably the most influential person in your professional life, and you've probably never heard his name. Back in the 1880s, Taylor was an engineer at a steel mill in Midvale, Pennsylvania. He invented something he called scientific management. The idea was methodical and ruthless. Break every job into its smallest possible components, time each with a stopwatch, and optimize each worker to perform their assigned task as fast and efficiently as possible, with zero deviation. Taylor was obsessed with one thing: preventing workers from thinking. Thinking introduced variability. Thinking was the manager's job. The worker's job was to execute the optimized motion until the shift ended. Taylor literally stood over men, shoveling coal, and told them the biomechanically efficient way to hold the shovel. He was not being cruel. He was being systematic. His methods spread everywhere within 2 decades, into factories, into offices, and eventually into the design of public education. The Prussian model schools that American education was largely built on operated on identical logic. Sit still for set periods. Follow the assigned curriculum. Raise your hand to speak. Complete the task given by the authority figure in the room. Do not deviate. These are not the skills of an owner. These are the skills of a well-calibrated component. You spent 12 to 16 years of your most neurologically plastic years being trained to receive instructions, execute tasks, and seek approval from authority, not to identify opportunities, not to read a balance sheet, not to examine the structure of an income stream. And then you graduated, and the first thing society handed you was a job. Of course it was. You were ready for it. You've been built for it. Congratulations, you are now a component in someone else's machine. The machine's owner studied ownership while you studied compliance. The salary is the final lock on the cage door. Nassim Nicholas Taleb said the monthly salary is one of the 3 most harmful addictions alongside heroin and carbohydrates. That's funny and also precise, because a salary does to your ambition exactly what a steady morphine drip does to your pain response. It doesn't eliminate the problem. It makes you comfortable enough not to address it. You know exactly what's arriving on the 1st and 15th. You calibrate your life to that number. You sign a mortgage that requires that number. You enroll your kids in schools that require that number. You build a life in which the cost of losing that number is so catastrophic that the very thought of risking it shuts down your decision making. That's not security. That's a hostage situation you walked into voluntarily and called it a career. Here's the comedic aside on this, and I genuinely cannot say it with a straight face. There are people who are deeply, visibly miserable at their jobs, who will complain about their boss to anyone who will listen for years, who will fight you if you suggest they might consider doing something else. Because the cage has a nice water bowl and they've forgotten that cages have doors. I want to introduce you to someone because his story runs through the rest of this video and illustrates the abstract mechanics better than any spreadsheet. His name is Derek. Name changed, real story. Software engineer, sharp guy, promoted to director of engineering at a mid-sized tech company in Austin in 2019. Good salary, around $160,000 a year. Equity in the company, but structured on a 4-year vesting cliff, tied entirely to staying. His friend Marco called him that fall. Marco was building a SaaS tool for dental practices, automated insurance, billing reconciliation, brutally boring domain, extremely valuable problem. Marco needed Derek to consult on the technical architecture for 3 months. The offer, $20,000 in cash, plus a 2% equity stake in the company. Derek said no, too busy, team of 12 to manage, quarterly goals to hit, a mortgage in a neighborhood where houses cost $700,000 because Austin was still booming. The math in Derek's head said, I have a reliable $160,000 coming in. This is a distraction. Inside the taxi, that logic is completely rational. Protect the next fare. 2%. Hold that number. I'm coming back to it. The psychological trap Derek stepped into has a name in behavioral economics. Researchers Daniel Kahneman and Amos Tversky showed that humans feel the pain of a potential loss roughly twice as intensely as we feel the pleasure of an equivalent gain. So when Derek evaluated Marco's offer, his brain wasn't calculating $20,000 plus upside. His brain was calculating risk to $160,000 already secured. The potential loss felt bigger than the potential gain, even though any rational expected value calculation probably favored taking the gig. And then present bias added another layer. The certain paycheck arriving in 2 weeks felt more real than equity that would take years to mature. This is precisely why smart people stay in the taxi. Not because they don't understand math, because their emotional architecture was built for scarcity management, not opportunity pursuit. The education system trained them to avoid wrong answers, not to find asymmetric bets. The corporate environment trained them to optimize within their lane. And the monthly paycheck trained them to prioritize next month over next decade. Stay with me, because this next part changes the entire frame of what we've been discussing. Here is what structural dependency actually costs over time. In numbers nobody puts on a whiteboard at company orientation. If you invest $200 a month, starting at 25, at 7% annual return, you will have roughly $525,000 at 65. If you wait until you're 35 to start same amount, same return, you will have approximately $240,000. The 10-year delay cost you $285,000. not from spending more money, not from making worse investments, from waiting, from treating someday as a plan. Delay is not neutral. Every month you spend driving the taxi instead of building the road is not time lost. It is compounding lost. And compounding loss is the most expensive thing in personal finance. There's also a second tax that doesn't appear on any form: mental bandwidth. Every hour you spend worrying about whether your job is secure, navigating office politics, preparing for performance reviews, and managing your boss's perception of your value is an hour your brain is not available for building. The employee mindset demands your full cognitive presence. The job needs you present, emotionally invested, responsive. This is a feature for your employer. It is a serious bug for your wealth building. The most successful investors I've studied, and I've read a lot of annual letters and shareholder reports, are almost always people who created large amounts of unstructured thinking time. Not scheduled meetings about opportunities, just time to think. Your current employment structure is specifically designed to prevent that. Now, back to Derek and 2%. Marco's dental billing SaaS tool grew steadily. By 2022, 700 dental practices were paying around $400 per month. Do the math. $280,000 per month in recurring revenue. In 2024, Marco sold a majority stake to a private equity firm for $11.2 million. Derek's 2% stake, if he'd taken it, would have been worth $224,000 at exit on top of the original $20,000 consulting fee. Derek's annual performance review that year, the very stability he'd been protecting when he turned Marco down, resulted in a 4% salary increase. About $6,400. He protected $6,400 and missed $224,000. He was so busy driving the taxi that he didn't see the toll road being built 6 feet to his right. Derek is not a tragedy. He's fine. He has a good life. But he knows the number. $224,000 is not abstract regret. It has a comma in the middle. He feels it every single time Marco's company comes up in conversation. Now, here is where the practical mechanics come in, because I promised you specific moves and I'm going to deliver them. Let me give you a concrete example first, because I want you to see yourself in this before I give you the framework. Meet hypothetical James, 40 years old, regional sales manager, $90,000 a year, a 401k with $60,000 in it, house worth $320,000 with $200,000 still on the mortgage, $12,000 in a savings account, net worth approximately $192,000. He works 50 hours a week at his job and has roughly 10 hours per week of genuine discretionary time, time that currently goes mostly to recovery, television, and scrolling. James decides to deploy 6 of those 10 weekly hours differently. He's a sales manager, so he understands customer psychology and buying behavior cold. He starts a newsletter for small business owners about sales strategy. 2 hours per week writing it, 2 hours on LinkedIn promoting it, and 2 hours consulting his CPA about restructuring some income toward capital gains treatment. He also increases his automatic monthly index fund investment from $100 to $300, the extra $200 coming from a subscription audit he did on a Tuesday night. The Bureau of Labor Statistics reports the average American spends over $2,100 per year on subscription services alone. Not housing, not food subscriptions. $2,100 invested at 10% annually for 20 years becomes $133,000. Not from a raise, from canceling the gym membership, used twice in January. Year 1 for James, the newsletter has 240 subscribers, no revenue yet. The ETF contribution of $3,600 for the year has grown to about $3,800. Almost nothing. The flag is planted, and that's it. Year 3, 1,100 paid subscribers at $49 per year. That's $53,900 annually. Not from a raise, not from a promotion, from 6 weekly hours of work he was already qualified to do. The ETF portfolio is now worth approximately $12,000 and generating around $800 per year in dividends. Still modest. But something critical has changed. James's income is no longer 100% contingent on one employer's goodwill. If he gets laid off tomorrow, the newsletter keeps running. The dividends keep arriving. He lands his next position from a foundation of partial freedom rather than panic. Year 5, newsletter revenue holding around $60,000 annually. ETF portfolio with continued contributions has reached approximately $24,000. James has also taken on 2 consulting clients from his newsletter audience at $3,000 each per month. Total income in year 5, roughly $216,000, $90,000 from salary, $60,000 from newsletter, $36,000 from consulting, a few hundred from dividends. More important than the number, approximately 58% of his income no longer requires his presence in a specific office. He is no longer purely a taxi driver. He's 58% toll road. He didn't quit his job. He didn't take a dramatic risk. He spent 6 hours a week for 5 years building roads while driving the taxi. The taxi paid his bills while the roads were under construction. That's the exit, not a leap of faith, an engineering project with a functional runway. But here is the framework underneath the James example, because I want it explicit. 3 levels. Sequential, you don't skip ahead. Level 1, plant the flag. You need one income stream, just one, that generates money without your physical presence. Even if it's $12 a month from a dividend ETF funded with $150, the financial value at this stage is almost irrelevant. The purpose is neurological. The first time you receive money while you were asleep, while you were at your kid's soccer game, while you were sitting in a meeting about quarterly projections, something shifts in how you categorize yourself. You stop being purely a labor unit. You become, even marginally, an owner. That shift in identity is the crack in the Taylor programming. For most people, the easiest flag is a broad market index fund or a dividend-focused ETF. The Vanguard Total Stock Market ETF has delivered an average annual return of around 10.7% over the last 30 years. It requires no skill after the initial decision. It is the opposite of the taxi. It generates returns while parked. Level 2, productize your expertise. Take whatever knowledge, skill, or hard-won insight your professional life has given you and build something that delivers that value without your hourly presence. A newsletter, a course, a consulting framework you license, a process you document and sell. The test is simple. Can this generate revenue if you are sick in bed for 2 weeks? If yes, you've started building a road. If no, you've created a second job. The key mistake at this level is overbuilding before launching. People write 50-page business plans instead of sending the first email or publishing the first post. The road doesn't need to be complete to start collecting tolls. You need one functional booth. Level 3, buy other people's machines. This is conventional investing, but with a structural philosophy behind it. Not speculation, not trend chasing. Buying equity in businesses that are already working, index funds, dividend stocks, REITs, small allocations to individual companies you understand because you work in or adjacent to their industry. Every dollar you commit at this level is a soldier you've deployed. Soldiers who work all hours, don't need health insurance, and never call in sick. The wealthiest people I've studied are not the ones who work the hardest. They're the ones who built the largest army. Now you might be thinking, this all sounds reasonable, but where does the money to invest come from when I'm already stretched? That's the real question. And it deserves an honest answer that isn't spend less on lattes. The average American spends over $2,100 per year on subscription services, as I mentioned. But here's a more systemic observation. Over a 30-year career, in a 1% annual fee on a $200,000 investment portfolio costs you approximately $170,000 in lost compounding, not from bad stock picks, from paying 1% too much in fees to a fund manager who is also, by the way, still driving the taxi, just a more expensive one. The money to invest is almost always already inside your financial life. It's just currently allocated toward things that don't compound. I want to say something about complexity here because it matters. The financial advice industry has a strong incentive to make this feel complicated. Complexity justifies fees. Complexity justifies the existence of middlemen. Complexity makes you feel like you need help. But here is the distinction that cuts through all of it. Complicated means you lack information. Uncomfortable means you have the information, but it requires changing behavior you're emotionally attached to. Most people call things complicated when they actually mean uncomfortable. You already know the rough outline of what needs to happen. The taxi versus the toll road isn't a new idea to anyone who's watched a business documentary or read a Warren Buffett letter. The information has never been the barrier. The discomfort of actually changing the asset structure of your financial life, that's the barrier. And naming it correctly is the first step to overcoming it. Here's the thing about pattern interrupts. I want to be direct about something that almost nobody says out loud in financial content. The 3-level framework I just gave you is not difficult to execute intellectually. A reasonably intelligent person could implement all 3 levels in parallel within 90 days. The reason most people don't is not capability. It is that the employee mindset specifically discourages it. The Taylor system, the salary addiction, the status tied to corporate title, these are not abstract forces. They actively compete with the quiet, unglamorous work of building an asset. Your employer wants your full engagement. Your mortgage wants your financial compliance. Your social environment rewards professional achievement measured in titles and raises, not in toll road construction that nobody can see yet. Derek, by the way, is now advising 3 early-stage SaaS companies on his own time, outside his employment contract, legally cleared, no salary from these engagements, pure equity positions. Small ones. Maybe they become nothing. Maybe one of them becomes the next Marco situation. He's still at the Austin Tech company, still has a director title, but his mental model has shifted. He now thinks of the director job as the investor's salary, the capital that funds his life while the toll roads go up. He's late. He knows the $224,000 number, but the best time to build a road is 20 years ago. The second best time is right now. 3 concrete things, not eventually, not when things calm down at work, this week. First, run an asset audit. Write down every income source you currently have. Next to each one, write a single word, either presence if it requires you to physically show up, or asset if it generates money without you. Most people who do this exercise for the first time discover they are 100% presence. That's your baseline. You cannot navigate toward a destination you've never honestly located. Second, plant the first flag this month. Open a brokerage account if you don't have one. Fidelity, Schwab, Vanguard, the specific platform matters far less than the decision to start. Set up a recurring automatic purchase of a total market or dividend ETF. Whatever amount you can set and forget. $50, $100, $300. The automation is more important than the amount because willpower is finite and you will need it for harder decisions. The goal of this move is not to build a meaningful portfolio in month 1. The goal is to reclassify yourself in your own mind from someone who is going to start investing to someone who already is. Identity precedes behavior. The flag is for your brain. Third, have the tax structure conversation this quarter. Find a fee-only CPA, not a product selling advisor, a flat rate CPA, and ask specifically, given my current income, what percentage am I paying at ordinary income tax rates versus preferential capital gains rates? What would need to change about my income structure to shift even a portion into the capital gains category? This is not a complex question. A competent CPA answers it in 40 minutes. The answer might be worth tens of thousands of dollars over the next decade. The tax code was written as a map by people who understood exactly where the treasure is. You don't have to agree with the map, but it is deeply foolish to refuse to read it. The toll road is not built in a day. It's built in an afternoon, then another, while the taxi keeps running. And one day you look up and the road is there. The tolls are coming in. The taxi is still running, but now it's optional. That is the only financial transition that actually matters, from income requiring your presence to income that doesn't. Everything else is just a number on a check that stops the same day you do. Lazy investing built more fortune than crypto memes. The taxi's still out there. Meter running. Your call.